Hello and welcome to Tideline's 5th annual Compass series on the state of the impact investment market. I'm Jane Bieneman, Senior Advisor at Tideline. This event feels especially relevant to us this year, given all of the uncertainty and volatility in the market. We are at Tideline seeing resilience and even some momentum in impact investing. This is being driven from our perspective very significantly by large asset owners, which have been and continue to be entering the market. And we do think this reflects that these are investors that generally have a very long-term investment horizon. They tend to see sustainability as important to driving value, as well as managing risks over that long-term time frame. We also are seeing more globalization of impact investing, including in Asia Pacific, and we'll talk more about that today. And we're seeing more product from the largest global asset managers, including in newer asset classes to impact. And we think that is quite helpful to demonstrate the case and signal the opportunity. So we are seeing some encouraging dynamics. However, there's no doubt that the market has cooled. Fundraising, which started to slow several years ago, impact or not impact, has become very difficult. In impact, about 70 billion was raised globally last year in the private markets, which is an over 50% drop from the peak 2 years before. And we're seeing today's market conditions are particularly difficult for certain types of impact investments in certain geographies, for example, energy transition in the US. And so we're asking a lot of questions about how to navigate this market and how to continue to scale impact investing with integrity, which is our North Star. And I'm very much looking forward to today's discussion with our expert panelists. I have the pleasure of introducing them now. Lori Chatman is president of the Capital Division at Enterprise Community Partners. Enterprise is a leading nonprofit investing in community development across the US. Lori manages 20 billion of debt and equity tax credit product, and her platform is one of the US's largest focused on community development and particularly affordable housing. Tim Macready is head of global advisory at Brightlight, which works with values and faith-based investors such as foundations and high net worth individuals and helps them integrate their values into their investments. Tim previously was Chief Investment Officer of Christian Super in Australia and has relocated to the US to focus on clients in the US at Brightlight. Abbey Schmitt helps lead sustainable and impact investment efforts at GCM Grosvenor, an $80 billion asset manager and advisor. Abbey works with clients to design custom private market solutions across themes and sectors. And also works at a firm level on strategy and product development. Terezie Trivell is Director of Private Markets at the UN Joint Staff Pension Fund, which oversees $100 billion on behalf of the UN and member organizations. And Terezie oversees the private market allocation, which includes private equity, real estate, and real assets, and is about 20% of the total portfolio. So thank you all very much for being here today. And Abbey, my first question is to you, and I'm hoping you'll help set the stage a little bit further for our discussion today. From your seat at GCM Grosvenor, one of the largest allocators globally, would you tell us, please, what you're seeing broadly across the impact market? What level of interest, what type of interest, and from where? And would you share with us, please, what you see as the very important trends in the market today?
Of course. So we manage 15 billion markets. And I think across this, we're seeing 3 key shifts. One is customization over a one-size-fits-all strategy. The second is nuanced investor demand across region and investor type. And the third is increased co-investment demand. So in terms of customization, we're seeing LPs want intentional tailored strategies, and they're implementing through custom separate accounts, especially for larger investors. I think we're seeing LPs really ask, how can you align my capital with my specific impact goals? In terms of preferences, globally across areas like Europe, Australia, and Switzerland, we're seeing investors really double down on themes like net zero, biodiversity, and also just transition to incorporate some workforce and community impact. In the US, recent conversations have been more about regional economic resilience and themes like health equity. I think climate is still a focus from some investors like blue state pensions, insurers who want to invest to align with their climate resilient business strategy, as well as family offices and foundations who are very mission aligned. We have seen some LPs scale back a bit from net zero labels and stringent decarbonization targets, at least in terms of outward specificity. But I think we really are still seeing this focus on climate thematic investing, especially in areas outside of renewables like energy efficiency and circular economy. And then lastly, co-investment strategies are really gaining ground because single asset deal strategies can enhance impact targeting and reduce the blind pool risk that you might see with fund investing. And they also help investors gain fee efficiency. So just two quick examples of how we're putting this into practice at Grosvenor. We have a client program that's a climate-focused investment from a European corporate pension that's investing in infrastructure, single asset co-investments and directs, as well as funds. And they actually shifted from a generalist strategy to a custom impact strategy after their board set a net zero target. So we really partnered to define what their impact approach should be, and not just saying net zero, but also incorporating SFDR Article 8+, as well as just transition. And we really worked with them to backtest this custom impact definition to see what deals and funds fit. And we ultimately landed on a program that invests in climate solutions in hard to abate sectors, but also just net zero aligned companies, as well as digital and social infrastructure that expand access to healthcare and access to communications. And we have certain revenue thresholds to kind of act as constraints for this. One last example is a social program we have for a US family office and foundation that's a 100% private equity co-investment SMA. And their inflection point for impact was after a family health event. So they are now investing in expanding access and healthcare, access and quality of healthcare, education, and economic mobility with a place-based lens in the Carolinas, but also focusing on underserved communities across North America. So think a deal that might fit could be scaling low cost, high quality heart care and medical shortage areas. And we really are partnered with them to co-design KPIs, their impact theory of change, and what deal selection looks like for mission alignment. And I think one key point here is that we're focusing more on deal level diligence versus manager diligence to really expand that investable universe across generalist, specialist, and impact GPs to avoid overly conservative filtering, but also still be guided by impact frontiers and GIN to really balance that impact depth with scale potential.
Thank you, Abby. It sounds like intentionality and specificity is really a thread across your clients and the work that you're doing. Terezie, turning to you, you're responsible, as I mentioned, for private market investments at JSPF. We know the fundraising market, as I also mentioned, has gotten tough for all managers, including an impact. How does your pace of deployment look at JSPF relative to prior years, and where and why are you seeing more or less interesting opportunities in impact today?
Thank you, Jane, for the question. So yes, we are about $100 billion pension fund, and I'm responsible for the private markets allocation, which is about 20% of the pension fund. And about 2023 was the time when, together with our senior management, we decided that we would like to add impact investing across all asset classes in our pension fund. We quickly realized that the private markets area is an area where we can truly find some interesting opportunities for impact investing. So 2023, we did a lot of exploration, and in 2024, we were very busy updating our impact framework, and we put together an impact investment strategy to invest in impact across all private markets, private equity, real assets, which is infrastructure and real estate, and we just recently added private credit to the mix. So we try to invest across all private market strategies. We have an updated and more flexible impact investment framework. And I would say, just on a high level, what we look in impact, we truly prioritize the intentionality. We want a fund that has a credible theory of change and investment rationale, and is aligned with our themes. And being the United Nations, our themes are aligned with the SDGs. We also want impact management. We want to make sure that the funds that we consider impact have the measurability and KPIs that we're looking for and that are relevant. And we also consider the impact risk, right? So we want to make sure that the fund managers, for the most part, that we invest in, but we'll also be looking at co-investment, have strong ESG practices and governance and escalation if impact goals are not being followed. So within each impact strategy, we've identified themes that we look at that can be aligned with the SDGs. We find that infrastructure and private credit are the two areas where you can find some good opportunities. On the infrastructure side, we found that some renewable energy infrastructure and energy transition and electrification infrastructure are the two areas that we quite like. On the private credits, it spans across all different areas of impact investing. On private equity, as you know, there are many industries to look at. In private equity, we found climate, education, healthcare areas where we have been looking closer at. I'm happy to say that even though the fundraising has been challenging, we were able just last year to make our first 4 impact investments across all the 4 verticals in private markets. So we have a good start in impact investing. Our pacing for private markets has been, every year we update our pacing. We have our allocation set, and we continue to view impact as an important part of where we invest. Naturally, we are very focused on investing with managers that can produce strong risk-adjusted returns. That's first and foremost. But we also want to make sure that we have the impact overlay, that we can invest with managers that can truly help us make impact and align with the SDGs.
Thank you, Terezie. That's very helpful, and certainly the approach resonates that you're taking to look across asset classes is very much what we're seeing now with many other large allocators as well. Lori, if I may turn to you and the topic of U.S. community investment, would you tell us, please, at a high level about Enterprise's track record, which includes, of course, almost 5 decades of deploying capital into communities, and perhaps you'd share an example of a particular investment with us. And I'd also like to ask you to comment on how you are managing your business in this environment with the evolving policy, budgetary, et cetera, landscape that we're in.
A lot in there, Jane, but sure, let me give that a shot. So high level, since 1982, Enterprise has invested nearly $81 billion to help create or preserve 1 million homes across the country. And that's about the size or equivalent to the size of some cities. So we've been very pleased with the partnership that we've done to achieve our impact really through 4 major activities. It's by partnering and collaborating nationally to support the realization of solutions crafted by communities. And we execute that through 11 market offices across the country and a mission-based advisory services practice that consults with nearly 700 state and local governments, public-private groups or agencies, if you will, as well as philanthropy. We develop multifamily units, units, apartment buildings that house roughly 22,000 people across the Mid-Atlantic. We have a dedicated policy shop that advocates for affordable housing and community development at both the state, local, and federal levels. And I manage our $19 billion capital platform that's focused on affordable housing and community development projects through investment products across the risk return spectrum, including tax credits, fixed income, and equity. And a good example of our work is a project that we completed called Hope Workstation North. And it's a highly innovative, mixed-use, transit-oriented development project about an hour north of Seattle. A high-cost area is the way that we generally refer to that. And so using a combination of investment products, we help to provide 65 new apartments for people experiencing homelessness. And again, that very high cost region. And through that effort, we delivered $26 million in grants, debt, and subsidized equity raised through the sale or syndication of federal tax credits under the Low-Income Housing Tax Credit Program. Please pardon my voice. And the New Markets Tax Credit Program. And what's really unique about that property is that it co-locates housing with job training programs in a LEED Platinum facility. And so with the safe, affordable place to live, residents are able to focus on gaining skills, job training skills that allow them to access employment opportunities. And the facility also provides on-site assistance from specialists to help them in those efforts. About a few years ago, when we looked at the results of that investment, 87% of the residents coming out of homelessness were able to stay housed and either at HopeWorks or other affordable housing in that particular community. 350 individuals, have completed the 10-week job training program, and 50% of those individuals that completed the program were immediately employed. So great outcome from that. So from that perspective, using those financing products, we were able to both provide housing that's affordable and job skills and employment opportunities that help them stay housed. And I think the question in terms of how we're navigating kind of the current domestic policy environment, we're looking at both risk and opportunity in this environment. Inflation is moderating, but certainly costs are still high, particularly for housers. And part of that inflationary pressure focuses on building, but for housers and owners, the other inflationary pressure, quite frankly, comes from the rising costs of insurance here in the U.S. So we're advocating at both, again, the federal level for tools that we know work firsthand. The Low-Income Housing Tax Credit, largest tool that has produced the most affordable housing in the country. New Markets Tax Credit, what was used to provide both housing, job training, and a facility that is LEED Platinum. And then we're looking at opportunity or efforts through efforts for opportunity zones, to the extent folks aren't familiar with that, which is a different tax credit opportunity that the current administration is heavily focused on. So tariffs, high interest rates, things certainly that are impacting a lot of our partners, and quite frankly, some of the policies that target programs at housing and urban development, fair housing rules are certainly a concern, and they threaten, again, affordability through efforts to potentially reduce Section 8 funding. Bipartisan support is where we see opportunity. Housing is on the national agenda domestically, and it's great that we have both sides of the aisle highly focused on this effort. And then the public-private partnership that really is through the housing credit keeps that at the forefront as a viable option no matter what the macroeconomics present.
Thank you, Lori. We certainly appreciate all of the work that you do, and in our experience, housing is more than ever on the agenda for folks, not just here in the U.S., but just about everywhere we look. So it's really helpful to hear about what you're doing. Tim, I'd like to turn to you. At Brightlight, as I mentioned, you're focused on values and faith-based investors. Would you help us understand what the opportunity is in impact among this group? How big or significant are they, and how are they responding to the current dynamics in the market? Are they stepping up, pulling back? What's their appetite today?
Yeah, thanks, Jane, and good to be with you all. As you've said, a lot of our work is with these values and faith-based investors, particularly faith-based asset owners and advisors, and we're seeing meaningful interest and movement within these groups, particularly around this idea of more deeply aligning their portfolio with their values and specifically with their faith. People who say that their religious beliefs and practice are important or very important to them are actually significantly more likely to have interest in then aligning their investment approaches with those religious convictions. Interestingly, I think traditionally we have often associated religious groups with divestment and corporate advocacy efforts, perhaps more than with impact investing. There's a lot of history there. Religious groups led the charge on divestment when it came to slavery in the 18th and 19th centuries, and then apartheid in the 20th century, just as a couple of examples. But the renewed interest from religious groups is shifting to the positive. There was a study last year of within the Christian community of retail investors that showed that they're actually investing for positive impact is more important to them in their portfolio than avoiding negative impact if they had to choose between the two. And then not just at the individual level, but at the institutional level amongst churches and religious organizations, we are seeing change, albeit slowly, from these just divestment-only focused approaches to more impact-oriented approaches. There are barriers. Religious communities often struggle to find financial advisors and consultants who can help them navigate the impact space to products that are suitable for them. And as many on the call will know, a lot of these products are only available to qualified purchasers, as well as institutional concerns about performance and governance structures that act as substantial barriers to change. I'm not saying that getting faith-based groups to do impact investing is easy, but there is interest and we're seeing that grow. The size of the market is very difficult to quantify, but we know that it's large. In the public markets, we know that faith-based strategies are seeing net inflows at a greater rate than the broader market. We believe there's hundreds and hundreds of billions of dollars invested in those strategies in the public markets. The assets owned by faith-based and religious groups is well into the trillions of dollars by our estimates. And so the potential for activating these groups is quite significant for achieving impact. In terms of how religious groups are responding to the current dynamic, I'd really just echo Abby's thoughts. There's demand for customization and for expression of specific impact preferences alongside various investment objectives and requirements. I would observe that faith-based groups are, comparatively speaking, more likely to be focused on social impact over environmental impact. I think it often feels safer for them to focus on social issues where their communities are typically united in a view of flourishing than on environmental and particularly climate issues where there might be divergence in views across the religious communities themselves, and the political divide can really come into play. And the governance structures can get in the way of those more environmental focused investments as well. So what we're seeing is a lot of interest in impact themes like employee ownership, giving opportunities for intergenerational wealth, affordable housing, tackling homelessness, tackling addiction. We're seeing investment opportunities in fighting human trafficking that are gaining a lot of traction, and just generally impact investments that are helping vulnerable and exploited people we see these find consensus a lot more easier than some of the other impact opportunities. That's not to say environment isn't a focus. There are certainly some religious groups focused on environmental and climate focused investment opportunities. It's just that I think the social impact gets a lot more consensus, and as Laurie said, it kind of aligns with bipartisan support in ways that are a little easier for religious communities to really get behind.
Thank you, Tim. That's really interesting. The kind of more appetite in social themes, potentially real scale opportunity in public markets, and customization continues to be a theme for us today. Laurie, if I could ask my next question to you. We at Tideline have been hearing a lot about the need to make the business case for impact, that in today's environment, more than ever, we need strong data that can hold up to scrutiny. Is that part of your role in what you do, making the business case, and what is that for community development finance institutions in general and for enterprise in particular? And I am curious, sort of while we're making the business case and thinking about that, how do we ensure that we keep communities and beneficiaries at the center of impact investing? Oh, and you are on mute, I believe.
Okay, thanks. I thought I had hit that. Pardon my voice again. Pollen, whole nine, so I apologize for that. But certainly making the business case is core to our investment approach, not just for kind of social good, but for the financial durability. We raise a significant amount of capital from commercial investors, if you will, and they quite frankly expect us to be able to tell both sides of that story. And so when we're able to secure buy-in from multiple constituents, and that includes, again, not only our investors, but local municipalities, residents themselves, we really are building kind of the success case for long-term sustainability. And I also think it's imperative that, as the old adage goes, you show our work to make sure that we're continuing. So with that, and the fact that, the reality is some investors really tend to be highly focused on exacting, each dollar, each basis point, if you will, I find it incredibly important to marry that with showing kind of the human ramifications of our decisions. So we work to continually bring the reminders of what we do to show what's happening with those investor dollars in real life. And so through that, or to do that, annually, we produce what we call our social return on investment report. And I think we'll be making that available in the chat. And it really looks to provide measures for outcomes at our fund, community, property, and resident levels. And our most recent report really goes deep on the topic of preservation, because preservation really is one of the most cost-effective, high-impact tools that we have in our quiver, if you will. And in this report, we make the argument that not only is preservation a critical part of addressing the housing crisis, but it's incredibly effective. Preservation costs 50% less than new construction. It prevents displacement and strengthens neighborhoods, and it's climate friendly because it extends the useful life of affordable housing stock that we already have. And since launching our first preservation fund in 2013, we've preserved more than 20,000 homes with strong returns to investors and residents alike. And we look at those as being equally important. And so while we look, or not while, we always look to put people at the center of our work. A few years ago, in telling kind of how I come to this, we did a piece in Next Billion in which I shared a guiding principle that I talk about often with my team. And it really is assessing the value of a project in terms of, are we respecting the community? And by that meaning, every community is unique because every community's resident is unique and their needs are unique. And so there's greater value we believe ultimately for the resident, the community, and investor when we keep that at the forefront. And you, again, can go to a variety of our channels where we share stories of residents in this social return on investment report that we're going to be making available. There's a resident in Cleveland who regained her health care while taking care of her mother just blocks from Guardian Stadium, right? So being able to be proximate to there while caring for her mother. A woman named Christine, formerly homeless, domestic violence survivor, by moving into affordable housing. You know, we've learned recently that a form of domestic violence is financial abuse. She's been able to regain her financial strength and get her credit, you know, back in shape as a result of living in housing that's supported through our Renters Wealth Creation Fund. And I believe we just posted information about that in the chat. And then another family moved in Austin after her son was being bullied. By moving into affordable housing, she was able to stay home and homeschool her son in an environment that was much more helpful to him. So we look at this as the strategies as having impact actually drives value, right? The impact strategy actually drives value. By preserving affordability, we can actually improve net operating income thanks to tax exemptions, quite frankly, or abatement from a state in exchange for serving a public purpose. Residents who have access to credit counseling and credit reporting, right, suddenly able to begin to build their credit is an important impact that we see. And then smart investing in efficiency tools across our portfolio is also critical to adding that value for both our residents, our investors, as well as community.
That's fabulous, Lori. You had me with the stories about those individuals and the impact there, but I really appreciate your connecting what you do to the financial returns as well, which I know are very strong in housing. So thank you. Abbey, turning to you and kind of continuing this discussion around performance and measurement. What is your perspective on the state of the market in this area? How well are we doing making the business case today in impact? Do you have what you need? Can you benchmark? Do you have the data that you need to make both the impact and financial case and analysis?
Yeah, I think in terms of the state of the market, we're seeing two things. One is that tools are improving. So LPs and GPs are better aligning on impact measurement and KPIs. And the second is this continued push and pull between standardization and customization around impact measurement that continues to be a bit challenging. So we're seeing people increasingly adopt leading third-party standards like GIN, the IRIS Plus metrics, Impact Frontiers 5 dimensions of impact. I think some metrics like TPG's impact multiple of money to better help quantify impact and create a financial evaluation metric is not necessarily widespread, but we're seeing investors create their own metrics that better help quantify scale, duration, and depth of impact. But this standardization and customization balance does remain tricky. We do rely on standards, but also want to ensure that there's flexibility to focus on what is most material or of interest to a client. So for example, take two sectors. In data centers, you might want to focus on KPIs around energy efficiency and water use versus healthcare. You probably want to focus more on access to care and outcomes for underserved patients. But some of these broader frameworks, like SFDR, for example, are asking investors to report similar indicators across industries. So that, again, there's this balance needed around standard reporting, but also customizing with KPIs to tell the real story of impact and risk. And this is kind of our approach at Grosvenor. It's very customized and client-driven. And our two key prongs of this approach are our foundational philosophy around impact, which is based in the GIN, as well as layering on this client definition. And we are tailoring frameworks across asset classes. So we're using the Impact Frontiers 5 dimensions of impact in private equity. In asset classes like real estate, we're working and layering in this like multifamily impact council framework and integrating these across due diligence scorecards, memos, and reporting. We're also adapting and adjusting upon the Iris Plus metrics for added flexibility. And on top of this, we also have a proprietary survey that we send our over 360 managers annually to collect different impact and sustainability metrics and tailor these by asset class. And this is really the foundation of our in-depth impact reporting to really measure these impact KPIs and tell the story and set the stage for actionable engagement. I think two other opportunities. One is around technology integration. So investors, for the most part, I think are still using multiple different data platforms to validate and structure their impact data in a more siloed approach. But this is evolving towards, hopefully in the future, one streamlined platform that we can use across diligence, monitoring, and reporting, and kind of reduce the multiple different efforts to collect the same data across investments. One other opportunity, as you mentioned, is proving the business case for impact, because returns are essential for continued market growth. And there's a couple of interesting anecdotes I've seen over the past few months. One is that early impact private equity funds from the giants KKR, TPG, and Bain are showing anywhere from 17 to 24% IRRs, which is actually in line with their non-impact funds launched at the same time, as well as some anecdotal evidence that sustainability integration can enhance exit multiples from a Bain Global Private Investor Survey. So I think we need continued proof points around this to drive the industry forward. And at Grosvenor, we're seeing really strong performance and impact across an expanding menu of themes and asset classes. And we're really focused on areas where impact drives returns. So for example, where decarbonization can drive cost efficiency, or where underserved communities can be an opportunity to drive enhanced revenue from these untapped markets. And we're seeing themes of interest across private equity healthcare, underrepresented managers, as well as climate. And climate in particular is becoming a multi-asset class opportunity, not just infrastructure, where there's historically been a large energy transition focus, but also private equity, credit, and real estate. And focused on these hard to abate sectors where the entry multiple may be compressed due to climate risk, but by improving the carbon emissions profile, we can actually unlock exit value. And we're seeing similar opportunities for social as well. Lastly, I'll just say we think there's a large opportunity in the middle market and lower middle market. It's an opportunity for highly scalable solutions with modest capital needs, and that's where we're focused most at Grosvenor.
Thank you, Abby. That's really helpful, and I'm glad to hear that we're getting proof points back, and that we're starting to get the tools and infrastructure to enable the kind of institutional capital to manage kind of institutional capital you're advising. Tim, I'd be interested in your views as well on the state of impact management and in particular measurement. So it's my first question to you, and also would be interested, given your experience working in a variety of regions globally, how you see appetite differing or converging from a regional perspective. So would be interested in your comments both on the measurement discussion we've been having, as well as how we're looking from different regions.
Yeah, so for many religious groups, I think there's a sense that the traditional impact measurement approaches capture only part of what they're looking for. There's the obvious things that religious groups might be looking for in terms of impact that aren't captured, like the SDGs, like religious experience and kind of building religious communities, for example. But there tends to be a small percentage of what we hear when faith-based groups ask for more when it comes to impact. We're hearing kind of demand for a deeper understanding of the way that the capital is affecting relationships between the asset owner, the asset manager, the portfolio company, and the community. We're seeing demand for things that capture traditionally non-measurable factors like contribution to ecosystem level change. Just one specific example, sacrifice is an important part of many religious traditions, and there's conversations happening about how we might measure things like sacrifice or solidarity or these kinds of concepts that are often found in religious communities. I would say that much of the impact measurement and management approach in these groups is still anecdotal. The current level of rigor often lags behind, not always, but often lags behind some of the established frameworks in the broader impact space. But there is increasing demand for verified impact reporting in some of these newer, more novel areas. And with that is coming more awareness of other measurement frameworks, creation of frameworks designed specifically for faith-based investors, and of course the inevitable argument about who should pay for impact measurement and management in the first place. Then turning to the second part of your question, I would say the rapid growth of interest in faith-based approaches to impact investing is definitely not a US-only phenomenon. The current product set is largely North American and European, but we're very aware of groups emerging in Africa and Southeast Asia in particular that are developing impact-focused products for faith-based groups in these markets. There's significant interest out of the Middle East as well. And then you look at kind of the environment in which this is happening, where, interestingly, the trade tensions are acting as both an impetus and a barrier. Amongst some faith-based groups, this has pushed them to respond, for example, to USAID cuts by seeking to increase the flow of investment capital to try to ease some of the potentially catastrophic effects of sudden withdrawals of aid funding. We have multiple clients specifically asking us about the opportunity for impact investment in Africa, in particular. But then amongst other groups, particularly those who might have some established governance structures with preconceived notions about risk return parameters in impact investing, it has perhaps caused them to double down on domestic impact opportunities over majority world opportunities out of a sense of risk and concern that perhaps some of the areas they might invest in could suffer as the result of tariffs, even though in the case of Africa, for example, I think it's roughly 5% of the continent's exports go to the US, and the European markets are the big opportunity there for many of those social and environmentally focused impact investments. I also think the current environment is galvanizing a sense within some of these groups in Latin America, Africa, Middle East, Asia, of the need to find investment pathways towards integral development that are less reliant on funding from or investment from the US. And within that, we see faith-based communities responding with questions about how their portfolios can contribute to impact in their region. There's not insignificant wealth in some of the faith-based communities in many of these areas. And so we're seeing, as I said, them start to turn their attention to how they can use their own portfolios to grow impact opportunities in their own regions, rather than just invest in the traditional North American, European public equity portfolios.
Thank you, Tim. Teresa, turning to you, I know at the UN JSPF, you've recently refined your management measurement system, including to help how you evaluate the impact profile of prospective investments. I'm wondering what feedback you would give fund managers about their own impact management practices. What are common strengths and weaknesses that you see? And I'd like to ask you also about labels. Does a voluntary or regulatory impact label signal something to you? Do you prefer to see that, or is it really not relevant? You're going to look at the framework behind the label and do your own diligence there.
Thank you, Jane. So look, even over the past 2 to 3 years since we started looking at impact, practices have matured and evolved significantly. On the strength side, I would say articulation of impact thesis and intentionality is one of the strengths that we see. Many managers today have a more explicit impact thesis, theory of change, and thematic alignment to whether it's SDGs or key sustainable themes like climate tech, healthcare access. On the real estate, it's the affordability and so on. I would say there is also more willingness to engage in dialogue with LPs, and not just impact claims, but also more dialogue on methodologies, data limitations, and LP expectations. And we really appreciate that when the funds are having an honest discussion with us, when we can provide our feedback, and then when they can honestly tell us where their limitations are. So I think that's always helpful, and we see more of that dialogue going on. And I also would say, as a strength, we see impact more embedded in the full investment process and used increasingly even as screening or diligence level, sometimes as go or no go for pure impact strategies. And that part is really important, because we see a lot of the non-impact managers, even as part of their due diligence screening, being aware of impact and being aware of their clients like us who are interested in adding sort of impact lens investment into regular investment. So we see a lot of the impact. The impact is now part of due diligence screening, even if you're not an impact investor. On the weaknesses, I think Abbey really summed it up well on the measurability and KPIs. There are still major inconsistencies, and it's probably mostly due to unavailability of data. Where we have become more comfortable with KPIs and measurability is on the climate side. So energy transition, climate, impact investing. I think it's a little bit harder on when you talk about the social themes, where really oftentimes we see managers defaulting to output KPIs rather than, actual impact outcomes. And the other weakness, I would say, is that we don't really have good data when it comes to impact and financial performance measurements, or impact and financial performance being tracked simultaneously. We really would like to see more of an analysis of how impact correlates with value creation. And I know it's not easy, but we would really love to see that. In terms of labels, I'd say we see labels as a useful signal, whether voluntarily or regulatory. It shows intent and strength in the process. But I would also say that we do not rely on them. Sometimes you have Article 9 funds that may have limited measurements of key KPIs, or actually some funds that are instead Article 8 that have stronger impact credentials. So we don't want to miss out on those either. So I would say in closing, we look at labels, but we still conduct a thorough due diligence and review of the actual impact strategy, the governance, and what the manager's impact contribution is.
Thank you, Teresa. That's very helpful. We'll now turn to questions. We've got a number of questions from the folks joining us. Thank you for those. We have a couple, Abbey, asking a little bit more for a little additional color, as much as you can provide, about the type of interest that you're seeing in customization, both from endowment and foundation clients, sort of as a group, where their heads are in terms of impact interest, and within decarbonization and social themes you mentioned. Are there some themes under those sub-themes that are particularly prevalent?
Yeah, I mean, I think with like endowments and foundations and family offices, it's so mission aligned, and the opportunities are so tailored to their unique goals. But just to try to expand on a few more themes, we're seeing a large focus on, supporting vulnerable populations, whether that's underserved communities, the elderly, like regional populations. We're seeing some people think about impact and look at a company or a fund and say, okay, like, what are there any negative impacts? Are there any positive impacts? What is kind of the overall kind of net impact of those? And I want to invest in those types of opportunities. Some people do have very climate focused agendas and maybe are blending that with sustainable food and nutrition, for example, and kind of having this food, health, and wellness theme. So I think, you know, there's so many different themes and different conversations that we've been having.
Thank you, Abby. We have a couple of questions about venture capital and why we haven't talked about that today and what the outlook is in impact investing for venture capital. I might open that to the group, whether venture capital is an area that you're seeing significant from an asset class perspective in impact investing today. Is it more challenging in this environment? Or are you expecting to see appetite for that?
I'm happy to kick off, Jane, and then other panelists can jump in as well. I think one of the challenges for venture is often the funds that are being issued with a significant focus on meaningful, measurable impact are often quite small. I mean, we've had clients invest in an anti-trafficking fund that is a $20 million venture fund. We've had focus on job creation, particularly amongst vulnerable populations or in economies where job creation is difficult. We've seen venture in the health space, in the tech space. There's funds focused, for example, on kind of what it looks like for the next generation of tech companies to be driven by a sense of moral purpose and conviction. There's definitely interest, and I would say amongst our faith-based clients who are willing to kind of go out into the riskier end of the spectrum, venture is actually seen as one of the most attractive ways of achieving measurable, tangible impact by deploying capital. So definitely part of the equation. It faces the challenge of when you're scaling and you've got clients who want to make a minimum investment of $50 million, impact venture becomes a very hard place to deploy meaningful amounts of capital. So it tends to be the smaller investors we find that work in that space.
Thank you, Tim. And I mean, I think that's consistent with our experience, which is that venture has been a meaningful part of the activity we've seen at Tideline, but it is a riskier asset class, relatively riskier asset class, more economically sensitive. We have a question that, Lori, perhaps I could turn to you around residential real estate and housing, which is how do we make the case around sustainability and affordability as being, as you articulated, connected and not mutually exclusive? And are there particular resources? I would put your report out there, but are there resources that we would point folks to?
So for over 20 years, well, not quite 20 years, probably 17 years, Enterprise has been working primarily in the multifamily space versus the single family home ownership space to identify what are those investments that actually deliver not only climate benefits, but cost benefits for both owners as well as residents, as well as health benefits. And we do that through a tool that we've created or guidance that we've created called Enterprise Green Communities Criteria. We've now updated that. I think we're potentially on our third or fourth iteration because technology has certainly changed over time. And through that, the entire effort is to help developers, builders, owners of affordable housing understand which of those investments we actually know can benefit those communities. So I would encourage, and I don't know to the extent we can, if not now, there'll be other opportunities to share links to our Green Communities Criteria. And we've used that in a way and engaged that in a way where now I believe we're up to 46 states use that as an option for folks applying for subsidy to be able to indicate how they are going to incorporate those criteria to improve the viability, sustainability, and overall resilience of multifamily properties that are in development or being significantly rehabbed.
Thank you, Lori. We'll take one more question and then we'll go to our roundup, but we have several questions around the use of technology, including AI, around data management. And so I would be very interested to hear from one or two of you on how you're incorporating technology and potentially AI and how you're managing data for analysis and reporting. Would it?
I'm happy to take a stab.
Sure.
We so currently use a couple different providers. Like one of them is Reporting 21 or Cordy to kind of house our data infrastructure system and help us with our annual surveys and feed into reporting. Also using like MSCI to help collect and validate carbon emissions data, among other providers. And I think, again, as I mentioned earlier, like the opportunity is to better kind of combine all these into one provider, ideally. And then in terms of AI, we are exploring various solutions to better scrape all of the different data that all of our hundreds of managers submit to us, and better tell those impact stories with KPIs that they might not be formally submitting in a survey, but that we can pull in from their impact reporting and other data that our investment teams have in data rooms. So I think that's where we are headed.
Thank you, Abby. I think this is very real time. And after decades of talking about, is there anything better than Excel spreadsheets, even for the biggest investors? We are on the cusp of this actually happening. So it's, I think, going to be exciting. Terrific. So I will turn to our final question. I'd like to ask the same question to all of you, and perhaps the discussion of technology is a good bridge to this. But as we look out over, call it a 5 to 10 year investment horizon, what do you see as the most significant mega trends that you or your clients are focused on? And I'd be interested if those have evolved as a consequence of recent market developments. So I will, why don't I go through the same order of the first round of questions, which will be Abby, then Teresa, and then Lori, and then Tim. So Abby, turning to you.
Sure. I think three quick reflections for the future. One is that the future is customized and cross asset class. Lines are increasingly blurring between asset classes, and impact is no longer just a sleeve, but I think it will really be a lens for entire portfolio construction. The second is that impact is really for everyone. Maybe not everyone uses the language of impact or sustainability, but everyone wants to benefit their own communities or communities that they care about. So I think we're going to see increased demand across regions and investor types. And then third, hopefully we'll see enhanced solutions to enhance transparency and show measurable progress and show these links to value creation, because ultimately institutions will scale with managers who can deliver returns and these stakeholder aligned progress.
Thank you, Abby. Teresa?
I like everything Abby said. It's hard to really top it, but from the UN standpoint of view, we do believe impact is here to stay, and we have always taken the approach that impact is part of our private markets investing. We're overlaying our private markets investing with impact. And, I hope that in the 5 to 10 years, we'll see what we saw when ESG funds were coming out. There were ESG funds and flagship funds, and now everyone is a sustainable investor. So hopefully in 5 to 10 years, we'll see all these flagship funds having impact embedded in their sort of flagship investment thesis. So as the UN, as an investor, as a person of personal interest in impact, I'd like to see impact becoming more mainstream. And yeah, we have a lot of work that we have to put into bringing technology in and using technology and AI to collect data and using data methodologies to become better and sharper investors, and overall just make sure that we can invest across the entire globe in impact.
Thank you. Lori?
Yeah, I'll start a little different with the AI piece in terms of, I think we all agree, and you pointed out that housing costs have gotten more expensive globally, right? Not just domestically, but which is where we focus. And we'd be naive not to really seek opportunities to have that, look at ways in which we can begin to reduce the cost of housing development, gain more efficiencies in what is a fairly lengthy and burdensome process in the U.S. specifically, that adds to that cost, right? So can that technology in any way help speed up, because time is certainly money in a lot of ways. Insurance costs are rising, and the responsibility I think that we have to each other, given the reality that natural disasters are occurring everywhere at this point, we have to rethink how we insure, and should insurance be a public utility, right? And from that perspective. But I think for us, one of the most exciting places we're looking is the ownership lens investing space, which is a very hot topic now. And again, we see is only growing. And a lot of this is currently focused on employee ownership, but this is also growing in the housing space, and not strictly as home ownership. One thing we believe is that we simply need to talk about renters more than we do currently. Often, a lot of our focus is on home ownership, and that takes up a lot of the oxygen in the room. But the reality is that homeowner households and home ownership is becoming increasingly out of reach, and therefore, renters are much more or a much larger part of how folks are choosing to live. And traditional home ownership can't be the only path to sustainability or stability for families and wealth creation. So how do we begin to invest in ownership structures that allow renters to participate? And again, our Renters Wealth Creation Fund is one way that we are seeking to tackle that.
Thank you, Lori, and Tim, to you.
Again, echoing Abbey, I think customization and personalization is the direction that we're headed. And this is true in faith-based groups and non-faith-based groups, where there's just this increasing desire to align personal values and convictions with investment portfolios, and an increasing willingness to change advisors, change consultants, change portfolios in order to achieve that. And so I think we will see more and more values-aligned products coming to market, and more products with very specific impact areas. I mentioned human trafficking is probably not an area where most people think, impact investment's the solution to that. And yet we're seeing products in that space, and many other spaces like that. So customization and deeper impact, I hope, is the direction that we're heading.
Thank you, Tim, and thank you to all of you on the panel. It's been a privilege to have this discussion with you today, and thank you to everyone who dialed in to join us. I will be digesting this discussion myself for some time, but really appreciate that we've heard both, I think, about more mainstreaming of impact, to use, Abbey, your language, it's for everyone, but also not just Lori with the focus here on community investment in the US, but Tim and Abbey both mentioned sort of supporting vulnerable communities is really an area that folks are looking at too. So it was great to hear that we are that we have not lost the purpose focus. So thank you all. We really appreciate it and look forward to continuing these discussions.
Thank you, Jane.
Thank you.